Okay. The Mega Millions California lottery is at an astounding $1.15 billion with the estimated cash value of 516,100, excuse me, 516,100,100 to be drawn on December 27th. If you are to win, hopefully, then what would make sense? And this analysis right here is going to be relevant for anything, anytime you have an option of taking a one-time payment or accepting it over multiple periods of time. In this particular situation, over 30 years. Should you take a lump sum payment or annual payments? And I'm going to briefly look at taxes, the tax impact, as well as the potential investment. So here we go. That's me, Michael Wander. This is just saying again what I just mentioned in the earlier side. There are going to be a few other considerations that you might want to consider, such as, do you trust the government to hold on to your money for 30 years and pay you out for 30 years? Consideration. So this is what would happen if you took the entire amount as a lump sum. So if you took $1.15 billion on day one, your taxes would be in 2024, because this is when the winning occurred, would be $425 million, 458. You can see the number right there. This is how it's calculated. You can see, you can do the calculation yourself. It's a progressive tax system. These are based on current 2024 rates. And your net payout would be $724 million. Not a bad little payout, but let's compare. If you took it over 30 years, essentially annualized payments as an annuity, you would get $38 million per year gross, taxable income, right? Not considering all other potential items, just let's say this is your only taxable income. The income tax on this would be $14 million. You see right here, this is $14 million. And the net income per year would be just $24.2 million. That is what it would look like. So again, well, let's keep going. We'll see, we'll compare them in a second. So what happens under the lump sum option? Total taxes paid will be $425 million. Under, if you have it annualized, it's going to be $424,245. And that right there is going to be simply based on the $14 million. If you just multiply this 521 times 30, that's going to give you the 424,245 right here. So if you have it annualized, total taxes paid are 424,245. If you take a lump sum taxes, it's 426. The difference is going to be $1 million less taxes paid if you get it annualized, because you're going to be a higher portion of it will be under the under the lump sum payment. You're going to get higher taxes, taxed higher over here. Now, there are other things to consider. So just based on this, you would, let's say you would annualize it, right? $1.2 million, maybe you should annualize the payments and pay less taxes. But let's look at something else. What could you do with a lump sum payment of $724 million? Could you invest it and make, at a bare minimum, 1%? I think even at a bank, you could probably make that much. I'm not sure actually, but 1% growth would be very easily doable. So the interest just on this net payout after paying your taxes in year one In 2024, the interest on that would be over $7 million, right? That's the annual interest that you would be earning. Total investment revenue, if this interest is your only investment, total investment interest revenue after 30 years, you take this $7 million and multiply it by 30, and this is what you get, $217 million additional interest revenue. So total revenue after 30 years, total revenue will be 941. This is after tax. But keep in mind, I'm not looking at the taxes that you will need to pay on the investment, on the interest revenue, right? So that is a consideration, but I believe this analysis should still hold because you will have interest, taxes on interest in both scenarios, but just keep that in mind. So 217, so total revenue of 941,904, almost $1 billion, which is a 724, plus the 217. Right, it's $941 million. Now, if you took the annualized option and you took a payout of $38 million, so I had to update this slide because I initially was including the gross amount, which you're not going to be able to invest. You have to invest, you're only able to invest the net amount of $24 million per year. So 24 million, investing 24 million, 191, approximately 192 at 1% will give you annual interest revenue of 241,918. Over 30 years, that will give you total investment or interest revenue of $7.3 million. So $7.3 million, approximately after 30 years, will give you total revenue after 30 years of $733,011,919, and that will give you, that is from these two numbers right here, the 725. What's going on here? Yeah, 725, 754, 376, which is the annualized amount of the net income you will receive after taxes, plus the investment income you will have earned, interest, right, at 1% that we just calculated and estimated here. So look at these. Total revenue, if you can invest at just 1% and taking taxes into consideration, your total revenue under the annualized method will leave you with only $733 million, whereas under the lump sum amount, because you're able to invest at 1%, that's going to give you $7 million per year in interest. And the difference is 208,000, almost $209 million. That is what, and so that is what the difference will be. Definitely preferable, as you can see right here, under the lump sum. Again, assuming the 1% investment and not taking into account taxes on the interest revenue, which is going to be a factor, something that I would consider if I were winning this lottery here or working with somebody who did. Now, last slide. Well, I guess that's it. This is me, and this is my contact information. If you win the lottery or have any other questions for a CPA regarding lump sum payments or annualized, I'd be happy to talk with you, and we offer a complimentary consultation.